Welcome to Master Wealth, your source for financial wisdom and wealth building strategies. In this video, we'll provide 9 powerful tips covering topics from making money, saving, investing, diversification, planning, and networking. These insights require dedication, patience, and hard work, serving as a roadmap to early retirement and financial security. Remember, your commitment, adaptability, and financial responsibility are key to success. Now, let's delve into these tips, but please be mindful that this video offers education, not investment advice. It's important to do your research and seek expert guidance before making financial decisions. Let's get right into the video. The primary rule for accumulating wealth is to ensure that your money endures for future generations. It's a noble goal to build wealth for the purpose of passing it on to your descendants. Consequently, exercise caution when considering any type of investment. Many individuals lose faith in investing after falling victim to scams or experiencing a market collapse. Since investments are crucial for achieving financial independence, this is a common occurrence. Do you recall the dot-com boom in the early 2000s? Stocks of numerous online companies were artificially inflated by media hype, attracting many optimistic investors. Take the example of Pets.com, an online pet supply store with a famous sock puppet mascot. It went public in 2000, raising millions, but also spending just as much on marketing and distribution. Unfortunately, it failed to generate sufficient income to sustain itself and went bankrupt in less than a year. This meant that investors lost everything as the company's value plummeted. It was akin to tossing money into a never-ending void. Thousands of investors lost their life savings, and the entire market lost billions. It was a colossal shock and a dismal failure. Another instance is the wine fraud case of Rudy Kurniawan. Numerous investors made substantial wine purchases without possessing any knowledge of wine. It was an ill-advised move, and it turned out that the wines were counterfeits. Many people lost millions of dollars due to this fraudulent scheme, and they still haven't recouped their money at the time of this writing. These cases underscore the importance of taking precautions to preserve your wealth for the long term. They provide 2 real-life examples of individuals who lost money by investing in items they didn't fully comprehend or verify. It's easy to imagine how devastating it must have been for them to watch all their hard-earned money disappear in the blink of an eye. You might be wondering how to avoid such pitfalls and make sound financial decisions. Where can you find reliable recommendations and information? The best way to address this issue is to thoroughly research the field, asset, or company you intend to invest in. Additionally, seeking guidance from a financial expert is also a wise move. The next tip for growing your money and retiring comfortably is to be smart about handling debt. Consider how you intend to use debt, to your advantage or disadvantage. Learning the ropes of managing debt can keep you out of financial trouble. Let's simplify with an example. Imagine you want to start a business. To do this, you borrow $40,000 from the bank. In this case, the borrowed $40,000 serves a purpose that makes financial sense. It helps you create something that has the potential to generate income and increase in value, making it a sensible use of debt. Now, suppose you want a car, so you choose to borrow $40,000 to purchase a car. This is an example of unwise debt. Here, you've used borrowed money to buy something that won't earn you more or appreciate in value. In fact, it may even depreciate over time, making it an unfavorable financial choice. A financial hiccup could spell trouble in this scenario. The first case demonstrates how well-planned debt, considering interest rates and investment returns, can be a wise choice. The second case shows how thoughtless borrowing leads to financial problems. Good debt can increase your wealth, while bad debt can diminish it. Buying clothes on credit is an example of poor spending. Responsible debt management can speed up your journey to financial independence. On the other hand, careless borrowing can harm your finances and keep you stuck. Debt is a powerful tool, so use it wisely. Before taking on more debt, ask yourself, is it good or bad debt? Is it manageable or excessive? Is it helping or hindering my goals? Honest answers will help you use debt wisely and avoid unnecessary trouble. Another essential tip for growing your wealth is to diversify your investments. Consider diversifying your investments like planting a garden. If you put all your seeds in one patch of soil and a pest or disease strikes, you risk losing your entire crop. But if you spread your seeds across different plots, even if one is affected, you still have a chance for a fruitful harvest in the others. Diversifying your investments works in a similar way, helping you manage risk and increase your potential for long-term financial growth. Relying solely on one investment for your retirement is incredibly risky. Investments come with varying levels of potential gain and loss, and their value can go up or down unpredictably. This is why diversifying your investments is crucial. Diversification means spreading your money across different markets, reducing your risk exposure, and increasing your potential for long-term growth. The next piece of advice for increasing your wealth is to cut unnecessary spending. In today's society, the pressure to accumulate more and more material possessions is strong. It's no wonder that people often indulge in spending on things they don't really need. This can lead to living beyond your means and piling up debt. While spending money may provide short-term relief from stress and anxiety, it's not a wise long-term choice. It's not just about pinching pennies anymore. Embracing a simple and uncluttered lifestyle can bring happiness and gratitude. While it may provide peace and contentment for yourself, it might puzzle others. So, what's the alternative? Aim for balance and contentment with what you have, but avoid wastefulness. The next step in achieving financial independence through investments is taking advantage of tax deductions. Utilizing the tax system to your benefit is a secret often used by the wealthy. Taxes serve more than just a government funding purpose. Understanding and effectively applying tax regulations can help reduce your expenses and increase your available funds. This makes it easier to accumulate wealth and sustain yourself with your investments. For example, you can deduct mortgage and business loan interest from your taxable income, reducing your tax liability and leaving you with more money to invest. Additionally, income from investments, like dividends or rental income, is taxed at lower rates than active income, such as earnings or salaries. These tax benefits can enhance your financial literacy and provide greater financial control. However, it's important to note that tax rules vary depending on the type of income and how it's earned, which is closely related to whether it's considered passive or active income. Did you guess which type of income is typically taxed the most? You're correct. Active income is the answer. The tax rates on active and passive income generally have a progressive structure. Why? Because active income, like wages or profits from running a business, requires your time and effort. In contrast, passive income is earned from investments or assets without the need for ongoing, active involvement after the initial capital outlay. The IRS has different tax rates for these distinct income sources. For instance, Passive income like investment dividends and capital gains is taxed at more favorable rates compared to active income. Rental income, another form of passive income, also qualifies for tax benefits due to deductions for property maintenance expenses like depreciation and amortization. These tax advantages favor passive income over active income. Now, let's discuss the next tip for building wealth. It's important to have a portfolio that can withstand tough times. If you want to grow your wealth independently of economic ups and downs, you need to create a portfolio that can weather market fluctuations. During challenging times, you want investments that can endure the storm and still provide returns. This way, you can protect your finances from the impacts of economic downturns and market uncertainties. Here are some suggestions on how to do that. You can consider adding precious metals like gold and silver to your investment mix. These metals are rare and valuable, and they tend to remain relatively stable, if not increase in value, even when markets are volatile. Diversifying into gold or silver can help safeguard your portfolio from potential losses in stocks and bonds. Another option is to invest in dividend stocks, which are shares of companies that consistently pay dividends to their shareholders, regardless of economic conditions. Some of these companies have a track record of increasing their dividends year after year, irrespective of market fluctuations. For example, Coca-Cola and Johnson & Johnson are well-known dividend aristocrats. While these stocks generally offer stable dividends that may even grow during economic downturns, they do carry some level of risk. A third approach is to consider investing in a structured settlement annuity, which is a form of annuity policy. This option comes with lower expenses and potential tax benefits. However, it's important to note that you may face limitations on accessing your principal when needed. Last but not least, a wise investor always sets aside some funds for emergencies. When a crisis hits and the market experiences a downturn, many stocks become more affordable. This is the perfect opportunity to use your cash to buy these stocks at a lower price. When the market eventually recovers, you'll have a portfolio filled with valuable assets acquired at a discount. The best time to find these opportunities is when others are anxious and uncertain, turning a crisis into a chance to enhance your wealth. Another valuable piece of advice for enhancing your financial well-being is to exercise caution and develop a clear investment plan. Can you achieve financial independence with some effort and a well-crafted investment strategy? Absolutely! A thoughtful plan can help you reach your financial goals more efficiently and avoid common pitfalls. Let us explain why it's essential to have an investment strategy. To make the most profitable decisions, you need to understand the ins and outs of investing and have the right knowledge. A well-considered investment strategy can help you avoid costly mistakes, ensuring you don't miss out on opportunities due to lack of expertise. Think of it as having a trusted advisor by your side, guiding you towards secure, consistent returns. Your investment plans allows you to track your progress. For instance, if you aim to retire debt-free with a comfortable lifestyle, you need to calculate how much money you should save and the time required. To generate an annual income of $80,000 from a $1 million investment portfolio at an 8% annual interest rate, you need this information. How much can you save each month, and how can you boost your savings or returns? Adjust your plans if needed. An investment strategy empowers you to pursue your dreams and align your finances with long-term goals. Whether it's buying a home, starting a business, taking a sabbatical, or retiring early, it keeps you focused on your financial goals. A well-thought-out investment plan can boost your motivation, financial knowledge, discipline, and goal-setting skills. Remember that while investing is crucial, it's not the sole goal. Balancing saving and spending is vital for sound financial management. Smart investing matters, but so does enjoying your money in ways that bring happiness. Money isn't evil. It's a useful resource that can open doors to independence and opportunities. Treat yourself when you achieve your goals, but don't carry the weight of worries or sadness. Maintain a healthy balance between your financial priorities and the other aspects of life. Time with the loved ones is precious, so cherish those moments. None of us can predict the future, so maximizing our time together is key to achieving your financial objectives. So go ahead, enjoy the fruits of your labor. The next tip to expand your wealth is to consider surrounding yourself with prosperous individuals. Think of it like learning to cook. Would you prefer to hang out with those who've never cooked a meal, or those who are skilled chefs and can show you the way around the kitchen? The choice is clear. Similarly, when it comes to building your wealth and securing your financial future, being in the company of people who've already achieved your financial goals can be a great asset. They can motivate, guide, and encourage you as you strive for your financial objectives. You can't simply expect a millionaire to become your best friend out of nowhere, but connecting with like-minded individuals who share your financial aspirations can lead to valuable opportunities. Don't hesitate to build relationships with financially successful people. They might provide you with valuable insights to help you reach your goals. And here's the last to help you make more money through your investments. Don't let negative thoughts get the best of you. We mean those times when you think everything's going wrong, the world's a mess, and investing is a waste. But that negative voice isn't telling the truth. Thinking like that can make you miss good opportunities, make bad investment choices, and just make life less fun. Instead, try being hopeful and looking on the bright side. When you're positive, investing becomes more enjoyable, and you'll be a better investor and happier in general. So, how can you stay positive about money and investing every day? Share your ideas in the comments. We've just gone over 9 powerful tips for growing your wealth through investments. These tips cover everything from making money, saving, investing, diversifying, planning, and networking. They're based on solid economic theory and extensive research. If you follow them diligently and work hard, you can retire early and enjoy a comfortable life built on your hard-earned savings. But remember, these tips are not magical solutions. They require self-discipline, patience, and persistence. You need a strong work ethic, a thirst for knowledge, and the ability to adapt to challenges. To take control of your life, you can't rely on others or leave things to chance. Keep in mind that the journey is just as important as the destination. Money is a means to an end, not the end itself. When used wisely, it can greatly benefit you. One last piece of advice: don't delay securing your financial future. Please note that this video is for educational purposes and doesn't offer investment advice. Before making investment decisions, do your research and consult experts in the field. Investment values can rise and fall, and past performance doesn't guarantee future results. Consider how much you can afford to lose and your financial goals before investing. We hope you've learned something new and enjoyed this video. If you found it helpful, please like and share it with others. Don't forget to subscribe to our channel for more content on building wealth. Until we meet again, we wish you success in your financial journey, and may your investments yield fruit.